Welcome to the Everyday Trader. This is Greg. Another day of doom scrolling on Twitter. Oh, wait, that's not what we're doing. Eric, good to be here with you, my friend.
Wow. Interesting times, as you always say, an interesting week or interesting day in the markets. A lot has changed since we talked last week. Things were rather sanguine and calm, and now we've had major crises just shaking the markets here. Some surprising moves in both directions, really accelerated moves to the downside in certain areas and big changes in bonds. By the way, our call on buying TLT last week, which was a really was a good call, I think.
It is. I was going to say, I was watching the bond, especially the 10-year yield. I don't know that I've ever seen it drop this fast. And in fact, I just made a comment on Twitter. Maybe wasn't the best comment to make. It was, the dog in the room with everything on fire, tweeting.
This is fine.
This is fine. Everything's fine. The chart that they shared, it was the CME group who was talking about the intraday volatility on treasuries right now is exceeding 2020 levels, the panic of COVID. Well, and the COVID lockdowns. It's just amazing the vol we're seeing in treasuries right now. And I think some of it is in relation to, obviously some of it is in relation to what's been going on with the banks. The failure of Silicon Valley Bank last week and Silvergate, and the subsequent panic that ensued across the rest of the small regional banks. The money is flowing out of those banks into JP Morgan and Citi and Bank of America right now, with the fear of, is my money going to be safe? Are my deposits going to be safe? And then the news today, of course, with Credit Suisse across the pond saying they're basically having a similar issue of a credit crunch right now in Europe. And I'm sure that a lot of this is flight to safety. There's a lot of capital that had been maybe looking at risk markets that is now just like, put me in bonds. I can't even hold cash right now and feel safe that cash is good in my bank. And so they're running to bonds right now. And I don't know if that's the right answer or not, because then the other thing, of course, that's happened this week is our inflation data. And I know we're going to talk about both of those. So I'd love to hear your take. Let's dive into what's going on with banks right now, and whether this is systemic, whether this is okay, or whether we even know.
Yeah. So you and I were talking before the show a little bit. I think the theme of this show has to be a quote from Donald Rumsfeld. I remember back when they were talking about intelligence and stuff happening in the Middle East, and he used the concept of the known unknowns and the unknown unknowns. And I think there's a lot of unknown unknowns that are happening right now. I pulled up, you mentioned volatility in the bond market, and this MOVE index, which is getting a lot of attention lately. Usually this is a sleepy little index that doesn't get a lot of attention, but as of, through last year, we saw just epic moves that have happened in the bond space, that, things that we've never seen before, like 4 or 5 standard deviation moves that really shouldn't be happening in the bond space. And this volatility is of historic proportion. So this is right now, we're at 169-ish on this MOVE index. That's today. There's only one period in time when we were higher, and that was the global financial crisis that happened back here. And yesterday we were, this other peak here is the COVID crisis. So COVID caused major turmoil in the market, and just some other epic events that have happened in the past do not compare on the scale of this volatility index that we're seeing in bonds that are happening right now. We've seen historic moves in treasuries, as you mentioned, that we've not seen. And I think this is all related. And I think it falls under the category of the unknown unknowns. So what's really going on behind this. We have this failure of this bank in Silicon Valley, and there's a lot of stories going out and a lot of opinions from different people. Certainly a lot of emotion from the people who are affected by it, especially those people who are venture capitals, the like of David Sachs and Jason Calacanis, obviously feeling, the pressure and the pain because they probably have money in companies they have money invested with, are not able to make payroll. I think we ended on Friday hearing that some companies weren't going to be able to make payroll because they couldn't get money out of the bank. Over the weekend, of course, the Federal Reserve and Treasury and the FDIC and, of course, the president all got together and said, we're going to backstop and make sure that the depositors are whole. Whether or not shareholders are going to be taken care of, that's another question. It certainly opens the door to ask the question about, is this the right thing to do? Should we be letting banks fail if they're taking risks? I don't think we fully understand all of the reasons, but a big part of the reason for what happened with Silicon Valley Bank is a run, and that there's all these anecdotal stories of investors or let me say startup executives calling each other and tweeting and text messaging each other saying, I can't get my money out, you better get your money out, and everybody making a run on the bank. And it reminds me of the show It's a Wonderful Life, right? When everybody makes a run on Bailey Savings and Loan because they all want to get their money out. Well, the money's not sitting in an account. It's invested in, it's in Harry's home. It's in your, I can hear the words, and that's a little bit of that is what's going on. So I don't think we fully understand how much of this is related to the Federal Reserve and raising rates. I think that's part of the catalyst. Some of this was certainly emotional and psychological. There's also, things that are coming up about banks not taking appropriate risk measures. Silicon Valley Bank used to be one of the banks that was part of the stress tests. And a couple of years ago, there was a change in the regulation and they no longer have to be meeting the same stress tests. So people pointing fingers at that. Unknown unknowns. But what are the known unknowns? I mean, the question that I have, and maybe this is a known, and I'll throw this to you, Greg, is what links will the Federal Reserve and Treasury and the FDIC and Congress and the POTUS go to secure confidence in our financial system?
I think you have to realize that a known about the Fed and government, you're right, and the United States government and Treasury, they'll do whatever they have to the detriment of the US dollar, the credibility of the US dollar. They'll do everything they have to keep confidence alive in the consumer and in our depositors and banking institutions. And let's kind of separate the difference between what the Fed's been doing with interest rates and their role as that confidence piece behind depositors. The Fed was created in lieu of the Great Depression and all the failed banks that happened there. And it was created to have certain tools available to help banks that are in the failing process to fail within the system and not become contagious. That's really one of the things. And that's really what the Fed did over the weekend, is they stepped in and they saw the fact that Silicon Valley Bank and Silvergate and those failed banks were potentially causing some fear amongst other banks. I mean, just as another anecdote, personal situation, I had a couple friends call me on Friday, and they run small businesses to medium-sized businesses, and they asked, I'm like, my money's at, one of them was at Zions Bank Corp, one of them's at a local credit union. This is where my money's at for my business. Do I need to be worried about it? And it's a legitimate fear out there right now amongst people because of what they watched happen with Silicon Valley Bank. Take a step away from, hating on the tech IPO guys and how many millions of dollars they had sitting in there that you could make an argument wasn't fiduciarily responsible on the company's risk standpoint. But this contagion could have spread, and we were seeing the small to medium sized banks get absolutely pummeled on Friday, because of Thursday and Friday, because of this. And so I think the Fed did the right thing to try to stop that contagion and make people confident that my deposits are safe. My deposits are going to be backstopped by the government. So I think that's a known. That the Fed's going to do everything they can to make sure we feel comfortable about holding money in cash at a bank. The unknown known, or maybe the known, let's put it this way, this is a known unknown. The Fed has still got a problem with inflation. And I don't think they can stop raising rates, because this inflation issue, in the bigger picture, if you take, I shouldn't even say the bigger picture is controlling that contagion, not panic, right? You have to control that. But if there's a backstop, which they put in place over the weekend, that I'm comfortable, they have to step back now and say, man, this inflation issue, they've got to keep raising rates. The question I had, and I threw it out to you before we started as well, here's an unknown. Do you think the Fed has known, there we go, that this was going to be part of the collateral damage that was going to happen with them raising rates as fast as they were? There were going to be some banks that were acting inappropriately, whether it be out of leverage or speculation. And you can go back to the blow up of, the crypto exchange a few months ago and tie in this same thing. I mean, that was a part of collateral damage of what the Fed was doing. Now we're seeing these banks have risks because of what the Fed's doing. But do you think there is a discussion amongst Fed members that says, we know this is going to happen because we're having a paradigm shift financially, where we've been at zero interest rate policy for 15 years. And we've got to come to a realization that interest rates at 5%, the Fed funds rate of 5%, is not the end of the world. We can live and operate with a Fed funds rate at 5% and still all interact as a society and have commerce. And we've got to somehow break the bank's idea and businesses' ideas that I have to have 0% interest rates or we can't operate financially.
Yeah, we've been there before. Much higher interest rates, the Fed fund rates. I mean, I think anybody that's been trading over the past 10 or 15 years is freaking out. But historically, we're probably about average, maybe below average, going back, even to the 70s. We've been much higher. We've had this abnormal rate. And it reminds me of the quote is, we don't get to see who's swimming naked until the tide goes out. And we've created, the stimulus was there intentionally, but it allowed bad businesses and bad banks to probably operate with more risk than they should. And this happening, I think you asked the question, did the Fed expect this to happen? Well, I mean, I'm sure you've seen the tweets as well, that the Fed raises rates until it breaks things. Bianco's got some good stuff out there, and this is definitely breaking things right now. And Chris Whalen had some good stuff out on Twitter as well, that people are panicking over bank failures, but that's a normal thing. Banks fail all the time. We just haven't had any major failures in the past few years. And a big part of the reason why is because we've had this ultra low rates, and it's expected that banks will fail. In fact, the last time that we raised rates, in 18 and 19, we had multiple bank failures. It was expected, and it's expected now. And you started talking about something that I think is really important. And while the Fed is responsible for supervising banks, that's half of what they do. The other half of what they do is try and control inflation and try and control full employment, or reach full employment. Arguably, we have a very strong labor market. We've talked about that here. They're doing a great job, I guess, in terms of full labor. But in terms of controlling inflation, they're doing a terrible job. And these two things are distinctly different. The Fed, the market is if you go look at the CME FedWatch tool, I think there's an utter disconnect between reality. So right now we're at a 450 to 475 current target rate among Fed funds. That's the same thing that's shown right here in this chart. There's a probability, and since you and I talked, this was 50%. It's gone up to 58% now, just in the past hour. The probability of no increase in this meeting that's next week, a week from today. And in June, if you look at the probabilities, we're forecasting a greater than 50%, actually a 63% chance of a rate cut. And I think the market is completely disconnected from the reality of the fact that inflation is not under control.
I think the market is trying to force. Now, you're right. I think it's probably more of a disconnect. You could maybe say the market's trying to force the Fed's hand into cutting rates, but I don't think that's the case. I think the market is so used to this paradigm that we've had of, well, things are bad, market's going down, so the Fed's not going to raise rates. It's already done the job for it. I actually saw a tweet about that earlier today. It's like, the last 4 or 5 days move in the markets, and this doesn't just mean the S&P either, the bond market as well. It's already done the job, the Fed's job for it. I think that's a disconnect. I disagree. I think the situation we're dealing with now is so much different than the past 15 years because of this inflation factor that you just mentioned. But that leads us to, well, I thought the inflation report was good yesterday.
No, it was terrible.
I know that was the general feeling, though, right?
I know. I was talking to a friend of mine, and he said, "Well, I thought the CPI was good." And I said, "Well, what made you think it was good?" "Well, the market went up." Well, that doesn't mean it was good. It's clear to me that people, and I get it. You and I get a little bit more wonky and dive a little bit deeper into the weeds. And we decided not to start with this to make people's eyes glaze over, but let's try and keep this simple. If you look at the components of what's in CPI, there's a long list of everything from, buttermilk biscuits to instant coffee and elementary school and gasoline and lamps and women's. I mean, there's this huge list of items that the Fed compiles, 338 items that go into this index. Each one gets an importance weighting. That's what this column is here, is the importance weighting. And we can see what's important in food getting a 13%. So we got these different indent levels, and I think level 4 is a good level to look at things. And that's what this is. These few items that are here, which is, what does that work out to be? It's like 56 items, 57 items, I think, that are on here that are sort of this nested level. And I've got it sorted by importance. So we've got rent, of shelter is up here as the most important. So CPI overall was up 4.4%. And these are the individual, this is the month over month change. And first of all, I would ask you, these are sorted by weighting. So these numbers get multiplied times the importance weighting, and we total it up and see what our number is. And if you do that, so just first of all, if you just are eyeballing this, the reds are increases, greens are the decreases. Does 0.4 feel right? It certainly doesn't to me, because it looks like we're heavily skewed here. And I guess I didn't actually go through do the math, but I guess the math works out. I mean, we come down here, we got some big ones that are down here, and maybe that's where that brings this number down. But let's just look at the top 5 or 6 of these things. So we've got used cars and trucks, and that's great that that's coming down. But how often do you buy a new car? Okay. Meat, poultry, all these other things are things you buy all the time. People are buying new cars, I don't know, at every 5 or 10 years or somewhere in there. So that's, is what it is. What's really bringing the big impact on this CPI number is 0.4 being so low is this right here. The second most important thing on this level is medical care and services. And this is an anomaly that's well understood to be artificially lower than normal because of some regulations that promulgated and passed in the first of the year that have lowered the price of insurance for people. And so we're seeing insurance premiums down for certain people in certain categories, and that is bringing down inflation on that category artificially. And we know it's going away. And that's the reason why our headline inflation is 0.4. If you pull that out, where would inflation be?
0.6.
0.6, 0.7, higher?
Yeah, we're looking at 7-8% potentially.
Yeah,
Headline CPI.
Exactly. A month over month change, which is, and even 0.4, that's still an increase. Like, inflation isn't going backwards. We're still going up. We're still speeding up. We're not going as fast as we were, but we're still accelerating. Like, we're still accelerating. Like, this is not, a lower number doesn't mean disinflation. Prices are still going up in certain areas pretty dramatically and having a dramatic impact. So yesterday, the market being up, we look around and say, oh yeah, the market went up, so this must have been a good number. That is not the case. CPI, and the people who understand it, if you look at Powell's, like, he's got this super core services number that pulls out, I think, everything outside of home building services. If you look at the inflation numbers there, and Sam Ryan's put a piece out yesterday talking about the spring break inflation, which is alcohol away from home, hotels, restaurants, and airfare. It's scary how big inflation is. And the biggest increase in inflation for this month was airfare. I think there's a 28% month, or I guess it's an annualized rate, 20.7 sticks in my head. We've got an inflation problem, and the markets yesterday didn't price that in. So these are two different things. So going full circle here back to, what's the Fed going to do? I don't think there's a chance we don't increase. I still think right now the market is pricing in a 0% chance of a 50-point basis hike. I think the Fed could justify a 50-point basis hike. Now, they probably won't, because they've seen the turmoil that's happened in the market and they want to maintain confidence. But I think 25 basis points next month, the month after, maybe the month after, we're going to be at 25 basis points for a while. I think the market totally has this wrong. It's completely disconnected. And I think it goes to natural human behavior of what you need to have happen is what you think is going to happen. And I think people need to try. I really, really do not want to see the Fed raising rates at all. I wish we were over, but we do not have inflation under control. Now, the other side of that is that PPI was surprisingly lower than expected. Than the latest numbers, that's CPI. PPI came in at negative 0.1 on the headline, which was much lower than was expected. I mean, we were expected to be, I saw numbers at 0.4 plus 0.4. So we had a really good PPI number in terms of showing that inflation is under control. But I think that one doesn't weigh as much as CPI, or more importantly, the PCE. CPE or PCE? My dyslexia.
PCE. The interesting part, all of this is coming in the middle of the blackout period that the Fed is in because of their meeting next Wednesday, where they cannot communicate per their rules of not trying to move markets before their actual Fed meeting. So I think this next 5 to 7 business days leading up to next week are going to be really volatile. We're going to continue to see big volatile swings in the S&P. And I think we got to keep an eye on I think this banking crisis has made the Fed's job even harder. But I do still agree with what you said, that the inflation issue is something that is front and center for the Fed. And the reason for that, for those people for those of us in the market who are sitting there watching the stock, we're like, stop cutting or stop raising rates. We start cutting. We need the markets to go up. Most of us are not dealing with the situation that the rest of the country is dealing with, who aren't really actively invested in the markets because they can't afford it. And the only way they're affording life right now is by racking up record credit card bills at record interest rates. And that's just a solution that cannot continue. The economy will break if we don't get inflation under control, and we're going to have massive misses on people, not being able to pay their mortgage payments, their rent payments, their credit card bills, their car bills, their student loan payments. All those we're going to start to see defaults on, which will then put further stress on an already stressed banking system.
And we are seeing data to that effect that the savings rate is crashing. Personal savings is crashing. It spiked incredibly high due to the stimulus, the stimmy checks that everybody got. We're seeing credit card rates peaking, and we're seeing defaults start to increase as well. Adam Jonas from Bank of America had a piece out yesterday and talked about watching out for auto lenders. He expects this turmoil that we're seeing right now to ratchet up, that auto lenders are going to probably tighten the requirements for loans. And you should expect that we're going to see car companies contracting in terms of total vehicles sold. So these things are going to play out, falls into the unknown unknowns, I guess, more is the sort of other ramifications we're going to see here. I just, it reckons back to the trading through 2008. I lived through that period, that crisis, and remember when Citibank was, had dropped from like 70 down to 32. And I remember where I was sitting on that day on October 3rd, which is right before the big crash, October 3rd, 2008. I was at a seminar, and there were a bunch of, some of the smartest people in the room, people from, big institutions and investors and market makers and hedge fund managers, and them all looking around saying, I don't know anybody who's not buying Citibank here. And then Citibank proceeded to drop to $7.
Yeah.
And I don't know that that's what's going on here, but we do have a large pile of unknown unknowns. We don't know what we don't know yet on how this crisis is going to play out. And I'm not trying to instill any sort of panic here. I've actually got some bullish trades going on right now. And I am hedged. Thank God I'm in some collars. And I sincerely mean that, because I'm in some collar trades, and my portfolio is hanging on right here, doing quite well. Those trades are good hedges to have. So I'm not telling people to pull money from their accounts, which brings up what's going on at Charles Schwab, by the way. You've seen what's happening there.
No, it had bounced yesterday, but
yeah,
are we back down today?
Well, I mean, just over the past few days, and that's people are just panicking and just pulling their money out. I also got to say that some of the blame belongs, the banks own some of this, because shame on them for not increasing the interest rate when they're making money. The interest rates, short-term interest rates, are going up, and they're not passing those short-term interest rates along to consumers or other people. So, I mean, if you look at the Google search for high, I saw this chart yesterday from Google or word trends or whatever, looking at high interest savings, and it's like all-time highs. Because everybody's saying, wait a minute, I'm not making any money on my savings account. So, the banks should have been voluntarily offering, hey, we're going to increase your rate. And they brought some of this on themselves,
Yeah, that, and the added, naivety of the risk exposure that they had with their interest rate move. This is specifically pointing to the failure at Silicon Valley Bank, where they had this huge bond portfolio and should have known better that if the Fed is going to start raising rates, which they telegraphed for a long time. We didn't go from 0 to 5 in one day. I mean, it was incremental. Although it was the fastest rate we've ever seen, they had the ability to hedge that, and they chose not to. They chose to, for whatever reason, inexperience. All the people running the bank had never seen this type of move before, so they didn't actually think the Fed would do it, or whatever it was, falling asleep at the wheel. You're right. A lot of this is on the banks too. So going forward, I think this creates some good opportunities long-term to pick up some companies. We may go back to our lows. I don't know. We'll see. 3,800 is a pretty important number for the S&P 500 right now. and we're only 50 points away from that. It was the number that we hovered around through all of December and the first couple of days of January as our lows that we did. If 3,800 does not hold, we may be retesting the October lows. We'll see as this next week unfolds. Speaking of this weekend, hey, I'm going to throw this out there right now. I know, very short notice, but if any of you who are listening are in Southern California and aren't already signed up to come and see us, we're going to be in Irvine Saturday. Eric and I, we're going to be there with Tradier, our brokerage partner, one of Options Animals best customer service representatives. One of our coaches, Warren Smith, is going to be there as well. So we're going to be talking, I'm sure, a lot about of what's going on, specifically how to control risk, how to use options to take positions in the market. So if you're interested, we'll put a link down below, as well as how you can sign up for that and come spend the day with us on Saturday there in Irvine. So,
and it's free.
Yeah, no cost.
So if you're in the area, so don't register unless you're going to come. But if you've got friends in the LA area, we'll put the link in the YouTube notes down below. But if you can come join us, we're going to be doing more of these in the future. Don't get in on a plane, but I think our next one is going to be in Orlando in April sometime. So maybe a good time to go see Mickey Mouse and get together and see y'all. But we're going to do some of these other one-day events around the U.S. and hopefully come. We also got some plans to do some of the 2-day events as well, adding more of those in, which is one of the best things about what we do here with our community. So looking forward to that. So lots of good stuff. I think it's a good time to stay frosty, as they say, be vigilant about what's going on here. I think there's more to come and how this plays out. You point out this very critical level of 3,800. If we break through that, look out below. I still don't think we're going to take out those lows, but it's a really good time because there's lots of opportunity. The VIX is spiking. That makes option trading very lucrative for people who understand how to manage that. This is a 20-year chart. If we look at a 5-year chart or a short-term chart, the VIX is spiking up. And I'm actually really surprised the VIX isn't as high as even it's been. We've talked about the VIX being broken with 0-day options and things like that, but we're definitely seeing increases here in the volatility indices, which does present some pretty good opportunities for people who understand how to trade options and manage their risk. So, this is really a good time to be trading. The liquidity is excellent. There's premiums that are there. I don't think this is the time to be pulling into your shell, and unfortunately, that's happening with a lot of people. So this is, I'm not telling people to go take risks and get out there, but if you understand how to manage a portfolio, manage options, you can definitely sleep well at night, knowing that really understanding what the limits of your risk are and being able to take care of some
I agree with that. I think right now is a great opportunity in the market. You've got a lot of people. You're right. This type of market panic makes people want to run to cash and hide. But the problem is, where do you put your cash now? You can't. We don't feel comfortable putting it in the bank right now. You can't put it on your mattress.
Wow.
Control your risk in the market. That's absolutely where I can do it. There is opportunity in this type of volatility, not just to trade it, but to protect your money too. So come learn how. That's what we specialize in. So thanks for spending the time with us. Anything else, Eric?
I don't want to be giving trading advice to anybody, but I'm confident that that my bank is a good place to keep my money. I'm not even considering pulling my money. Of course, it begs the question, where would you put it? I'm a little upset that they haven't gone ahead and offered me, better interest rates. But I think pulling your money out and putting it in a mattress is probably not good advice.
No.
The FDIC has, and just look at what's happened with Silicon Valley Bank, and the depositors are all going to be made whole, from what I understand. So I would expect that the Fed is going to do whatever it takes. You mentioned earlier there's a limit on the FDIC cap. I have no question in my mind that the Fed will print more money, which may not be good overall for the economy. This is the unknown unknowns, is how much money, how far will we go? So I think the Fed will do what it needs to do. And so next week, I expect Chairman Powell to address both these issues. And he will do what he can do to instill confidence in the financial system. And he's also going to talk about inflation. And I predict at least a 25 basis point, if not 50, next week. And the market seems to be totally disconnected with that.
Yep, agree with you there. So it'll be good to see you this weekend.
Yeah.
So we'll catch up there. I'm sure we'll talk a little bit more there. And until next time, don't forget to hit the like and subscribe button.
All right, everybody. Thanks. We'll see you later.